Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 11th, 2022. It's 2:15 Eastern Time. As I'm starting the video, I want to do a quick wrap up now. The markets still have a couple hours to go, but I'm nothing, barring anything crazy. Again, anything's possible in any environment when volatility is high, but barring any big move today, there's not going to be any very significant developments, particularly in this weekly time frame. So I'm just going to recap very quickly. So this is where we're at right now. Here's QQQ. You've seen this chart 100 times. I'm covering it almost on a daily basis, if not bi-daily basis recently, because it's really guiding my overall, to a very large extent, the overall outlook on the market. And I just wanted to say that here's where we're at right now. So you can see price right there in white, 328.04. We're at the bottom of that red candle. We're roughly approximately 3% up. We'd have to rally between now over the next hour 45 minutes at least 3% or so just to get, turn this candle green for the week. So that's almost certainly not going to happen, most likely not going to happen. And we're also about at 3% off the recent lows right there. So that's where we're at. And now, being that it's a red candle, that's what I told you, I wanted to see to comfortably continue to go home short over the weekend. It helps that bear flag scenario there with the move down, only one green candle along the way, and one green candle so far there. Still need to take out the recent lows. That's a given. I say that over and over and over. And there's still resistance levels overhead, such as the downtrend line. I believe that should be the same one I keep showing you on the 60-minute chart. But I'm going to show you a few more things here. There's the trend line on the 60-minute chart. And same thing on NQ futures. We're still below it. And so far so good. Boom, boom, boom. It's a downtrend. Let's not overanalyze it. If we take out the trend line and we start taking out previous reaction highs, then that intermediate term downtrend begins to be called into question. And the more previous reaction highs you take out, then the more it gets called into question. At some point, then you have yourself a new uptrend. But right now we're in a downtrend, so let's not overthink this. While you're in a downtrend, at least an intermediate term downtrend since the November highs in the NASDAQ 100, short the rips, cover the dips, or don't cover, if you're holding out for the big gains. Alrighty, now what I wanted to tell you is the NASDAQ 100 right now, there are 23 stocks that are green, positive in the NASDAQ 100. I have a real-time breadth indicator I came up with using this charting program, and so that means the other 77 are down today, and that's reflected here. But what's more so than that, up today, down tomorrow kind of stuff, is I'm keeping an eye on the 800-pound gorilla, the big dog in the room. Not only is it the largest company in the world, largest weighted, top weighted component of the NASDAQ 100, the largest weighted component of the S&P 500, and therefore it certainly has an impact on where the indexes go, but this chart's a little busy. Apple's also had a lot of relative strength compared to some other ones that have rolled over. Microsoft down quite a bit more. Microsoft being number two, down already about 22%. Amazon, great company, but this is what happens, and this one's down about 28%, so forth and so on, where Apple has been pretty darn resilient. And again, great company, can't knock it. But here's the thing: you see these 200 days, I talk about it. Apple, not during choppy periods, during trends. The 200-day is a great move, just like the markets. You guys know I've been harping on these 200 days on the NASDAQ 100, S&P 500 for a while. They do a great job during trends. Even during COVID hit, Apple briefly had a little spike through, panic selling, recovered it right away, and boom, every time you come back, that's where you want to buy it. And we recently had a test. But what's happening is, in a strong bull trend, you test the 200 and you never look back. You were given a gift, sometimes a little double test there. But we just tested it a couple weeks ago and we're already back on it. So we're watching those. I'm watching those. When the 200s go and they go with conviction, which I very strongly believe they will. My convictions on Apple going down is just as strong as it is on the stock market, and it's really almost a conditional thing. You're not going to have Apple holding up or going to new all-time highs with my next, my deeper price targets on QQQ getting hit. That just cannot happen. It will not happen due to mathematics, the weighting in the stock, and sentiment and everything else. You start going down more, as I talked about, margin calls get hit, and that's why people really have a hard time. I think a lot of people, even these analysts I listen on TV, they just can't even wrap their head around how such a great company with such tremendous earnings, just a solid business model, dominant in every just about every category, how it can not keep going up. Number one, they're buy. I'm sure there's more buys and sells on it. And then, but when you look around, I got covered here. Like any other stock, it's going to go down when the market goes down, and the corrections are pretty big. And these are bull market corrections: 35, 39, 34, 45, 26. Last bear market we had, Apple dropped 62. The time bear market before that, it dropped 82. So if okay, here's my thoughts. Not to be too dramatic, but if you're lucky, you're going to have a bear market correction. I'm sorry, a bull market correction in Apple, and it might be in the realm of one of those 34, 35, 45% drops, somewhere in there. Smallest one right there after divergent high. These were all the corrections, by the way, after divergent highs. That's what my chart's showing you there. There's our most recent, which is really an extension of the previous one. The first was a little first shot across the bow, but the divergence is extended. So, and where I think Apple's going before all said and done, obviously, there's a weekly chart. Got to take out those 200 days. You can see them there in blue. We're testing them again now after just 2 weeks ago. Like the markets, those pre-COVID highs are a logical target, and that is my target. It's going to come in with the trend line that I think we're going to, and that's about a 47% drop, not from the highs, but from where we're at now. I know that's heresy among Apple bulls and just about everyone, but that's where I think it's going. And hey, if I'm going to be wrong, I'm going to be wrong. I'm not going to, ride. I'm not short Apple. I'm short Apple via the NASDAQ 100, and most certainly not going to ride shorts if I'm wrong and we go up here and Apple just continues on to new highs. But that's where I think we're going. It's a very nice trend line, and even that is just really a secular bull market correction if we have it. It's just a pullback. These trend lines need to get visited, and they do get visited every so often. We haven't visited that trend line since back here, right there, since that fourth quarter drop, the Q4 drop in 2018. So that's it. And the farther away you get from something, the more powerful the mean reversion is. So just try to, you may agree, you may not agree, but I'm giving you levels that are going to increase the odds. Right now, that's the one stock that really hasn't broken down. It broke down from this trend line. I do have a sell signal on it here, but I'd like to see additional sell signal. Breakdown, back test. I want to see the 200 days, which are the 40-week moving averages, get taken out, and I want to see this channel, the trend line, this uptrend line, which defines this price channel. I want to see that go. And when that goes, we'll probably be in waterfall selling mode. Strap in, hold on. And hey, if you're an Apple bull and I'm wrong and you're right, well, here you go. Buy these 200s. You were given a gift every time Apple came to the 200-day / 40-week moving averages, even if it was a 1-week intra pop there like when COVID hit. You were rewarded, and you can go back for decades on this stock. As long as the stock's been around, buy. These are the 200 there. So I'm giving you, whether you agree with me or not, objective levels. And you can trade as you want. You can either buy pullbacks to the support, which is the MO in a bull market. Apple's still in a primary bull market. Might be in short-term correction mode. Or if you share, my mindset, then you wait to see that break, and you wait to see the trend line break, and then the last holdout really of the big fangs has broken, and at that point, assuming everything else confirms, that's pretty much what I call an all-in short moment. It doesn't mean you take your entire portfolio and load it up in puts and or futures. No, it means whatever percentage of your portfolio, assuming you even short it all, whatever percentage that you are comfortable allocating to an short on the equity markets or this one NASDAQ 100 or Apple directly, that's where you take your full position. At that time, if and when it even happens, I'll still most likely have my gold, my silver, in and out of other things, treasury bonds, crude oil, which will eventually break to and come down very hard, lumber, whatever it is at the time. My core holdings right now still are mostly bullish the precious metals and bearish the equity markets as far as core holdings. All right, so I wanted to show you that, and again, just watch the levels because we're not there yet, but we're very close. And on the daily chart, I know this is a busy chart. There's so many lines here, but the yellow ones I've had color coded here for a while, so you can see there's two lines. In a second, I'll turn this off so you can see it better in the video, and then I want to show you guys one other thing before I wrap up for the week here. I have two trend lines, one from here, one here. This is the August of 2020 low. That one there, that one's been taken out. Then I have this yellow support level here at about 157.30 or so, and I'm going to turn off the lines and let you see that a little better here. So here's what I'm looking at. Pretty much this right here. You had a major reaction high, and then you broke out the new all-time highs, which on face value is bullish. Always. A breakout to all-time highs is always bullish. Why is it bullish? Well, obviously not just because at that point in time, when any stock breaks out to all-time highs, there are zero remorseful holders of the stock. Everybody at that moment is profitable, right? So when stocks, that's why in a bear market you keep going lower. People are throwing in the towel, capitulating. They can't take the pain anymore. But in a bull market, everybody's happy. But and as I often say, fewer things in trading and investing are more bearish than a failed breakout. And that was, we successfully back tested it there. If we were in a strong bull market, there would have been a lot of buyers. That would have been the road to new highs. That would have been a gift. But what happened is we started from that point making lower lows. You got it. We're in a downtrend, a near-term downtrend. Primary trend's bullish, intermediate term is bearish. And now, most importantly, why I'm doing the video is you've got support. That previous reaction high, we successfully tested it once. Then we broke it down in the morning. Remember a couple weeks back when Russia invaded, was that the day or was it after that? There was a day that the futures, everything, the recent lows were taken out in the market. Apple did it, everything. And again, I shared my opinion. I believe there was strong government manipulation that came in, tried to, or maybe not. Maybe there was absolutely no directive from Washington to support the financial markets, because if you look at it from a technical perspective, Apple hit and kissed perfectly almost. That see the red and the blue lines? That's the 200-day and the exponential right here, and the 200-day simple right there. And so it was another test. So maybe the algos fired off as they're programmed to do, buy pullbacks to the 200-day, both humans and machines. The algos, the computer trading programs. But what's happened is the making of a when a uptrend ends, you have buyers will step in, but it's fewer and fewer buyers each time, and those buyers are being overwhelmed or met with more selling. People taking profit that were in the stock, or short sellers come in. And again, let's not overthink it. Let's just see and wait and see if that level breaks. It's not going to happen today, but it could happen next week. And so it's right about, again, I call it about 153. That should, a solid break below 153, especially a solid daily close, would take out those levels there, the 200-day moving averages, both of them, the simple and the exponential, as well as that price support right there that we're testing once again. And the other thing it would do, and I really need to see this, guys, it's still, for the most part, not an all-in moment, short in the market until I start seeing Apple and these other companies. It's on the majority of stocks in the NASDAQ 100 and a lot of sectors, and the S&P 500 as well. You get these positive divergences. And I said, in a bull market, they are typically the catalyst for a new rally, a new leg up that's multi-month and sometimes multi-year. And but in a bear market, divergences will begin to set up, but they just don't pan out. So if we can solidly break down that level, that's going to take out the divergences on Apple, which takes out the market leader at the knees. And overall, that's not good for the rest of the market. Maybe there's some sector rotation or stock rotation, out of Apple at that point into the beaten down ones like Netflix and all that. We'll see. And I do this. That's why every day I'm talking to, although I'll cover the markets for you 2-3 times a day, I like to include something new, something else I'm watching, and then you can decide whether you want to watch it as well or act on it, trade it, or whatever. Last thing I wanted to show you is the two things I want to show you. We'll start with let's start with consumer spending. I'm sorry, consumer sentiment. Grab that for you. 1 second. Okay, so consumer sentiment was released today, this morning at 10 o'clock. It's released every month. You can find that, by the way, if you go into the site, right side of the chart, you go to the support center, which is under here. You click resources right there. and then go down to right here. Sorry, tools of the trade, economic calendar, and that'll bring you to the this one here, the economic calendar right there. And that'll show you. So basically, we came in today, and they talk about it. If you're not familiar with all this stuff, what is it, consumer sentiment, and down here, the definition, they'll tell you what it is. Click on that why investors care. They'll even give you a further explanation. Well, and you can't see it. I know I'm not zoomed in. I can do that for you, certainly. Zoom, zoom, zoom. You can see that we came in. The consensus range was 59.0 up to 64.6. It came in at 59.7, which is at the very, very low end of the range, and also below the consensus, which is the expectation, the general consensus. And so, as it says here, consumer sentiment has been moving deeper into long-term lows, and no improvement is expected for March. Well, this is March, okay, and there it is. So came in pretty ugly, and this is what it looks like. You can go to, there's just Google search consumer sentiment chart. There's a lot of sites that'll give that to you. And this is it, and here's what I wanted to show you. All right, so first of all, know this. This is just economics 101. GDP, which is really, think of GDP as the profits or the earnings for the United States of America. You have Apple, every quarter they report earnings. Well, GDP, gross domestic product, is this, the combined of all our goods and services sold in the economy. It's really the, benchmark for how well the U.S. economy is doing. That's what they measure recessions on. 2 contracting quarters of GDP is going to be a recession. So you have consumer spending accounts for over 2/3 of gross domestic product. No matter how big our government's gotten, and it's gotten big, writing checks nilly-willy to everybody. They're going to beef up defense spending now, probably with Russia and NATO, all that. But again, to consumer, there's a lot more of us than there is, the federal government, at least what we spend and how we drive the economy, and we're again 2/3 of that. So you can see that this is consumer sentiment, and what I'm showing you here is this is what's happened. It started peaking, of course, when COVID hit. It fell off a cliff, right? Started going up, but it stayed. It never really, even though the stock market was doing this, there was a disparity, and that's because the stock market is not the economy. Don't ever confuse it with the economy. When you inject trillions of dollars of stimulus into the market and the economy, you can get a disconnect. So the consumer, a lot of people are getting hit hard by inflation and out of work and all that, and they get stimulus checks. But the increase in inflation has vastly exceeded all the stimulus that the government gave. In other words, those extended unemployment benefits and the checks, the one-time checks everybody got, has been dwarfed. And also, they say any wage increases. This inflationary environment's allowed some workers to negotiate and get wage increases, and that again has been wiped out and then some by the increased inflation, by how much more they're paying for a gallon of gas, a gallon of milk, and bread, et cetera, et cetera, et cetera. So what am I getting at? There it is. So here we're falling off a cliff. Consumer sentiment has fallen off a cliff. In fact, the only time in recent history it did that, not even back in the dot-com bubble burst. That was more isolated to just the overvaluation of the stock market. And a recession followed. It wasn't that bad. This is a Great Recession. We were plunging. And it was already coming down just like it was here before the market topped. Remember, the black here is the stock market, right? That's the stock market right there. And you can see stock market was diverging just like it was back leading to the top. The market peaked back here in October of 2007, and it was diverging from the consumer, or the consumer sentiment, at least how the consumer's feeling. And then it started falling off a cliff right around the time we got our first counter trend rally. That was almost like if you're in the shopping mall and it's or a zoo, you are here kind of map you walk up to with the little arrows show you where you're at. Well, maybe that was the first counter trend rally, but it didn't matter because the tide had already turned. Major forces were already in play. Consumer was already tucking in their shell, and then that final next leg down came. So anyway, I just wanted to point out, there we are. We're right at where we were back then, and again, you guys decide if you think it's going to have an impact on the market, or if the Fed's going to come in and save the day like they have so many times in the past. We know the Fed put, if there is still a Fed put on the market, meaning a floor, it's severely diminished. I believe, and others, it's wiped out. There's hardly much. If they do any more, stimulative effects on the markets, they're just going to just further stoke the flames of inflation. And things have been going up parabolic lately. Russia obviously did not help, but it was most certainly not the cause. Although the White House has been putting a full court press on, trying to tell Americans that's what's causing fuel prices to go up. You can just pull your own chart, pull a gasoline price chart for the last couple of years. You'll see it's just a continuation of a very clear and strong and existing uptrend. Anywho, that's that. So I wanted to show you what that was at, and then one more chart, and we'll wrap it up, and I'll let you get on with your weekend. That would be, okay, so I told you a minute ago that consumer spending was 2/3 of GDP plus. And let's take a look at the retail sector and see if it jives. Because sometimes people, I say this, that I like to use, I look at all the sentiment indicators for the stock market. They have bull bear polls where they poll people if they're bullish or bearish. But what I've always said is the problem with that is people don't have to necessarily put their money where their mouth is. You get surveyed, you might say, I'm bullish, I plan to buy, and that's what they ask. You plan to put money in the market, or you vote, yeah, I plan to buy Apple, I plan to buy this because I think we're going to be up in 6 months. But guess what? You can change your mind. You don't have to buy. Whereas a put to call ratio shows where people are putting their money where their mouth is. When that surges, then people are scared. They're buying a lot of put protection. That still, as I've showed you in recent videos, has not happened, at least nowhere close. It's come off the bottom after hitting the extreme, my sell indicator level, and staying there and giving me persistent, sell. I always said it's not a timing indicator, it's conditions. So now those conditions have triggered. That's where the market crash warnings I started issuing, a couple months back come from, or the elevated risk of a crash. Again, not a guarantee. And then we haven't seen that level of fear yet. As with everything that's gone on, with Russia invading Ukraine, with everything they're marching out on the news, believe it or not, we just haven't seen anything close to the spike on the put to call ratio to my level that I have, where that's your hard, but you hit that level every time it's happened, even especially in the bull market in the last 10 plus years, you buy. And so we're not there yet. Now I just want to wrap it up here with XRT. This is the Spiders Retail Sector ETF. As the name implies, these are retail stores. I'll tell you what's in here right now in order of market cap: Amazon, Walmart, Costco, Target, TJ Maxx, Dollar General, O'Reilly, Walgreens Boots Alliance, Kroger, AutoZone, Dollar Tree, eBay, Ross stores. You get it. You can go down the line. Those are your retailers. And so the market is, a great predictor of where things are going. And let me just turn off all the lines. So XRT peaked just like NASDAQ 100. That's when I first put, the sell signals are still intact now. We're back here in November. This is mid-November. And XRT, until the recent low, we're not far above it now, has already fallen 32%. So, and we're well below the 200-day moving averages. You can see them there. And according to my estimates, these are my targets right here. And the one that I think we go to before all said and done is probably down here to that 55-ish level right there. And at least before all said and done, that's about another 28% drop right there. And, there'll be a little stop along the way. Hey, maybe I'm wrong, and if I'm wrong, I'll tell you where I start to be wrong, but this is where I think we're going. There's a downtrend line like so many other things. We're in a downtrend, and like so many other sectors and indexes, we had about a year-long consolidation where the market just ran out of gas. The stimulus was powerful. Think of it like throwing a rock up in the air. You throw that rock up, the velocity of that rock is fast coming out of your hand. It's going to go up, and then it's going to slow down. And for a while there, it's going to appear as if, and it does, it stops. And then the momentum turns, and when the rock starts coming down, it begins to accelerate. That's what I'm looking at here, and so that's where I think we're going. And whether I'm right or wrong, you cannot argue this. The financial sector is down over 30%. Consumer confidence has plunged down to levels not seen since the last financial crisis, the Great Recession, they called it. and that was associated with a 55% drop or so in the S&P 500 and Nasdaq 100. So that's it, guys. I sit here every day, and if I have to, flip, I'll flip. When do I flip? Where I think things are going in my positioning. Again, incrementally. It's not one single line. As of now, as we head into the weekend, I just wanted to get this out to you in advance and let you know I see absolutely no reason for me to cover my trend slash swing short positions. So I'll go into the weekend short, even though we're still at that low, even though there's still some divergences, still a chance for pop. To me, it's about risk reward, and I think the risk of the market having a strong move to the upside and sustained rally, we're talking 10+% or a takeout of the previous highs, I think that is dwarfed by the potential for the profit on the downside or the potential for loss in the market. And so that's it. So we'll wrap it up here, and I don't think I'll get another one out today because I'm going to go knock off early and do some things I need to get done. But if anything big happens before the close, I'll be back in this evening and I'll get one out to you either later tonight or over the weekend. Otherwise, we'll pick this up on Monday. This has been Randy Finney with Right Side of the Chart. Have a great weekend.